Welcome to the Real Estate Espresso Podcast, your morning shot at what's new in the world of real estate investing. I'm your host, Victor Menashe. On today's show, we're talking about global debt and the multiple exit strategies from that debt. Every stream of cash flow must have an exit strategy. When you go to the grocery store and you put your groceries on your credit card, the institution who issued the card is lending you money. By the way, I don't recommend that you do this, but the path to repaying that loan for most people is their employment income. If you're being responsible with managing your debt and you've planned it out carefully, then you have a viable exit path for retiring that debt. Even though your groceries are going to cost you a bit more than they should, you can still buy groceries by servicing the debt from your income stream. All debt is a claim on future income flows. I'm going to say that again. All debt is a claim on future income flows. The critical decision is to ensure that you have debt that will self-liquidate. You want to be able to point to that consistent income stream that will take care of the debt without any unnatural interventions or refinance activities. If you don't have a dedicated income stream to repay that loan, then you're taking from another income stream to service the debt. As we go into an economic cycle where liquidity is going to reduce, and I'm going to prove to you that it will, debt is going to become more and more difficult to secure. This is because the quality of collateral is going to become more and more suspect. Now, we understand this at a micro level. Well, today, the Wall Street Journal reported that global debt is currently estimated at $290 trillion. And with the strengthening dollar, many of the debt payments denominated in U.S. dollars have increased in two ways. Number one, the principal amount has increased compared with the original based on exchange rates, but so too is the cost of servicing that debt. And many countries have seen their currency devalue by more than 15% this year compared with the U.S. dollar. Now, if the world's gross domestic product is estimated at $104 trillion, we're talking about debt that is almost 3 times global GDP. And if that debt is serviced at an even optimistic 5% interest rate, in many countries it's much more than that, that debt is supposed to be paid off in, let's say 20 years, when the world would need to be spending about $29 trillion a year out of the total $104 trillion in GDP on debt service. That's simply too high. That would represent 28% of all global activity going to debt service, and that's clearly not happening. The world would be in a massive debt trap with no ability to service the current debt. So it means some of that debt is being serviced as interest-only debt with no principal repayment. There's got to be a lot of debt that can never ever be repaid. We just don't know it yet because the interest payments are continuing to be made. Those loans are not yet in default. The only way to fix those loans would be to issue more debt, that is, to kick the can down the road and hope that the loan will survive another day. Now, an exit from a loan can happen in one of 5 ways. Number 1, the loan gets paid down to zero and it's fully liquidated. Number 2, the asset providing the loan collateral is sold and the loan gets repaid through the asset sale. Number 3, the loan gets refinanced into a new loan, often for a larger loan amount. Number 4, the loan gets modified and then liquidated or refinanced. Now, a loan modification is different from a refinance in that it involves a partial write-down or a softening of the loan terms. And then finally, number 5, the loan goes into default and gets written off as a bad debt. What we don't know is the counterparty risk associated with some of those debts that will ultimately go bad. Balance sheets show assets and liabilities. But once a loan goes bad, then an asset disappears from the balance sheet, and all of a sudden that party that thought they had an asset can't meet its liabilities. And with bank leverage, all it takes is a small number of loan failures to trigger a cascade of defaults that mushrooms in size. The only backstop is for central banks for whom the public trust is still intact to issue more debt, to print more money, and to hope that inflation will make the debt disappear over time. Now, the Fed has been saying for some time their target is to take inflation back to 2%. The market is clearly saying that they don't believe the Fed. The yield curve inversion, where short-term interest rates are so much more higher, almost 80 basis points higher than long-term rates, is saying one thing and one thing only. It's saying the market doesn't believe the Fed when it comes to interest rate policy. Either the debt will need to become more affordable or we're going to see defaults on a massive scale. There's simply too much debt, far too much counterparty risk, too much economic contraction, and too many constraints on food and energy. The bubble that we're currently in was largely of the Fed's making, and the down cycle is being amplified by the missteps of the Fed. The Fed has to accept elevated inflation and return to a stimulative footing in order to prevent a repeat of the 1930s. In the meantime, good businesses are probably going to be harmed for no good reason other than a mathematical model says the interest rates need to go higher to fight inflation, and it's not clear that there is an actual viable antidote to the debt-addicted economy that won't actually kill the patient. There's simply too much debt in the system, and debt traps are starting to appear. And this is where you need to pay close attention. Once the dominoes start to fall, the counterparty risk can cause lending liquidity to dry up quickly. We saw this in 2008, and I guess that leaves one final exit strategy for the debt. It's the one where the exit is rarely talked about. Simply devalue the currency through inflation and hope that the servicing of that debt will be through future dollars that are worth less than today's. That leaky bucket of inflation will erode the debt faster than the interest can accumulate. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.